silver's now engaged in. Silver will lead the upside, but gold has a momentum trend structure that is super hyper clear, 120 plus silver.
Are you watching at all the spread in the silver price between the West and China? I had Francis Hunt on the show recently, believed that China potentially setting the real price of physical silver.
If you're a supply demand guy looking at silver, you say, well, gee, we've had a supply shortage for 5 years now. We're producing less than we consume.
Gold has been in a pretty similar position to silver recently, chopping sideways since the Iran war began. I would love to get your forecast there. Do you expect a major move up this year in line with silver's path to 300?
Where could gold go? Even JP Morgan came out with a report several months ago that argued for $9,200 gold, like Jamie Dimon told us 2 weeks ago. You got a government bond crisis now. We're going to have to deal with it. He meant it's coming. It's now.
Particularly if we enter this new reality for silver, the 300 to 500 range, what would that do for the silver miner?
Probably more than silver. They're focused on, tariffs. Well, that worked for about 2-3 months. Tariffs didn't go away. And now the Iran thing. The market made a low and then shot up to a new high.
When it comes to price action in the run up to triple digits and now to where we are today, around $78 an ounce, looking back, I had you on the show several times and you called a lot of these moves in advance, but did anything about this price action surprise you at all? And what is it telling us about how this bull cycle is different from 2011 and 1980?
Well, those were confined in the 50-year box, 50-year range. Why was silver confined in a 50-year range when no other metal was? Copper wasn't. Copper blew up out of a multi-decade range back in 2005 when the average price had been $1 for decades. Suddenly went to $4.10 within several quarters. No, not even a headline story. Lead did the same thing in 2007. It had been in a range for multiple decades. Suddenly quadrupled in price in a matter of several quarters. No headlines. Gold, all the bull market peaks never stopped at a prior bull high. We had a $200 peak in 75. We had a $850 peak 1980. We had a 1920 peak 2011. It didn't stop at $50, at the same price level. But silver did, and you made the point. Manipulation. Okay, fine. We know that's occurred. But there's a point at which those who try to distort reality get killed by it. Because ultimately reality wins. And if they're still in the way, they'll get buried. And who knows, maybe they were taught a lesson late last year, early this year, about they can't contain this beast.
Markets broke out across metals, but silver alone stayed pinned near old ceilings for decades, and that mismatch should concern anyone trusting efficient pricing. Michael Oliver notes copper and lead escaped long consolidation ranges without the same repeated suppression at prior highs. That forces a harder question. Was silver lagging because of fundamentals, or because pricing pressure delayed reality longer than expected? If distorted pricing unwinds fast, conservative savers overweight paper exposure may discover diversification was thinner than advertised. Next, Michael Oliver reveals why long-contained markets often move most violently when control slips.
And whether they're still trying to do it, I don't know. But it didn't work before. In fact, if they created what you could call a market error by keeping silver too low, too long in real dollar terms, whereas other assets rose, like commodity, copper did, lead did, gold did, etc., then they've distorted reality. And sometimes when a market gets distorted, either too high for too long or too low for too long, what it does to compensate is sheer terror. It goes very rapidly to correct the error, like a rubber band breaks, okay? And I think that's what silver's now engaged in. And I think you'll see the evidence and the result of that by late summer when we come up out of this congestion. And again, we've got trigger numbers that especially we're focused on gold, not because gold's going to lead this. In fact, silver's beating gold over the last 4, 5, 6 months, handily beating gold, and still is holding gains versus gold. Silver will lead the upside, but gold has a momentum trend structure that is super hyper clear to us. And it won't take much above where we are right now, like another % or so. And gold's going to engage through that structure. You can't see it on a price chart, but you can see it on our intermediate trend momentum charts. It's a triple top breakout above a structure. And when we go through that, then we're going to pound the table to our subscribers and tell them, okay, the mama metal is saying now we're re-engaging. And I suspect that could happen very soon.
When an asset outperforms quietly for months before headlines notice, timing often matters more than narrative. According to Michael Oliver, silver has already been beating gold, while gold itself sits near a technical re-engagement zone. That divergence suggests institutions may watch momentum structure, while retail still reacts to spot price noise. For older wealth preservation investors, missing early phase breakouts can mean chasing inflated entries after risk-reward has shifted. Next, Michael Oliver exposes why gold's confirmation could validate a much larger silver repricing.
And when that happens, my bet is on the other side of that, 3 monthly bars later, after escaping this zone, we're going to be in that zone on silver.
Are you watching at all the spread in the silver price between the West and China? I had Francis Hunt on the show recently. He pointed this out and believed that it was a pretty significant development in terms of China potentially setting the real price of physical silver. Is this all noise to you as you're more focused on the technicals, or are you paying attention to that?
It's noise, but it's an attribute that is part of the overall picture. In other words, it's telling you something. Now, whether you can use it as a timing instrument, that's the different thing. I mean, after all, fundamentally, if you're a supply-demand guy looking at silver, you say, well, gee, we've had a supply shortage for 5 years now. We're producing less than we consume. And there's no end in sight in that regard. But how come silver didn't launch until just recently, late last year? 5 years of this deficit ongoing, and yet it was ignored or manipulated. But either way, these fundamentals are there. Yes, they are evidence. They're not necessarily invalid. It's just the problem. How do you use them as a timing mechanism? And that's very hard to do.
Let's switch over to gold and dispel some myths, because you wrote recently in Momentum Structural Analysis,
supply deficits can persist for years, yet price still refuses to reflect urgency until positioning shifts. What Michael Oliver is highlighting is that China-West pricing spreads may be informative, but not always precise timing tools. That exposes an institutional contradiction. Fundamentals are loudly cited after moves begin, not when accumulation quietly happens. Investors protecting purchasing power should remember that delayed price discovery can punish those waiting for media confirmation. Next, Michael Oliver reveals why evidence alone rarely tells you when repricing actually starts.
So many myths out there about how gold must drop with sharp stock market drops and also drop when rates go up. Can you walk us through why these beliefs are myths and lay out what you expect gold to do in the case of a sharp correction in the broad market and a higher interest rate environment?
I think fear drives more than greed almost in this case, where you look at a couple of examples going back 50 years or so in gold where you see a period of time where rates went up a bit and gold went down, et cetera. But when you look at, I don't know what these people are looking at really. They go back to the late 70s when we had global recession. They call it global stagflation because prices went up. The Fed drove rates off the page. Short-term rates and long-term bond rates, like 30-year bonds, went from a yield of 7.5% to 12.5%. Okay, right now we're around 5. Okay, so 7.5% to 12.5% vertical. Not just the Fed on the short end, but the long bond. Rise in rates. Gold exploded all during that time. It replicated the rise in yields. It wasn't hurt by it. Okay. And this has happened before. There's other times when gold's had a big move and yields have gone up and it hasn't mattered. That was a particularly strong evidence. But there's too many times that's not the case. Meaning, I bet I could do a moon phase analysis and come up with a better correlation for gold than whether the rates are going higher or not. Okay. And then with the stock market, it's the same story. Yes, there are times where during an ongoing bull market like 2001 to 2011 in gold went up eightfold.
The Fed can raise rates, yet gold does not always behave like textbooks promise, and that gap breaks comfortable narratives. Michael Oliver's argument suggests investors obsess over simplistic yield correlations while ignoring longer monetary stress cycles. If gold rose during prior aggressive rate surges, then the bigger variable may be confidence erosion, not rate direction itself. Savers relying on conventional rates up, gold down logic may underestimate how fast defensive positioning can reverse. Next, Michael Oliver unravels why fear-driven correlations often fail under real systemic pressure.
Okay. In the middle of that move in 2008, the stock market had been going down for an entire year, from 2007 to 8. Gold wasn't going down. Then in September, October particularly of 2008, the stock market, a year off its high and way off its price high, had what you could call a collapse month. More than 30% in 1 month, in weeks, in other words. Gold participated. In other words, it took a break in its major uptrend. It had a huge down month in sync with the stock market. At that point, Bernanke came in with a page out of the Japanese book and instituted QEs in November of 2008, a year and a month off the bull high. He'd been cutting rates all the way down. It didn't work. Okay. He did QE. And if you look at what happened to stocks starting in November 2008, they collapsed through March 2009. QE didn't stop the decline, almost 2 more quarters of decline. Gold during that time shot back to its highs and made new highs. Gold immediately turned on the institution when they instituted QE. In November when they instituted, headed back up. So it had an interruption, and yet people think, oh, that was with the trend. No, it was a 1 month in sync situation in what was a longer-term uptrend and a longer-term bear trend. Because the stock market took until 2013 for the S&P to ever even get back to its 2007 high. God, gold did eightfold move. Okay, so and yet the stock market was a wasteland.
A 1 month collapse can hide a much bigger divergence investors only recognize years later. This is where Michael Oliver's thesis shifts from price reaction to structural resilience. Gold briefly fell with equities in crisis, but recovered while stocks remained trapped far longer, exposing how panic and long-term trend are rarely the same thing. For retirement-focused investors, confusing temporary liquidation with trend failure can lead to selling protection at the worst possible moment. Next, Michael Oliver reveals what crisis-era reversals say about real monetary confidence.
So, all these correlations that people like to talk about, I think they're driven by fear. In other words, what could hurt me, rather than the correlations that indicate, boy, if they raise rates and go berserk, if they do, then gold will go up. Because if I do the correlation the other way, then I'd say, oh boy, I cheer that. Okay, so the public is too narrow in their view, and I think they're motivated more by fear than greed.
Now, gold has been in a pretty similar position to silver recently, chopping sideways since the Iran war began. I would love to get your forecast there. Do you expect a major move up this year in line with silver's path to 300? Do you think the markets will perhaps bifurcate and operate more independently as opposed to being correlated?
No, that will be the same. And a lot of people like to think of silver as an industrial metal. And if you go back and study, for example, the Bloomberg Commodity Index going back decades, and look at copper, for example, or oil or any of these things, they tend to move in large waves with, not necessarily month to month, but big move to big move, with the Bloomberg. In other words, they move like a commodity, okay? Silver doesn't. Silver moves with gold. And there are plenty of times, so for example, gold made a bear low in 2015. It went up and doubled by 2020. It went from 1,050 to over 2,000.
Markets label silver an industrial commodity, yet its strongest historical behavior often aligns more with monetary stress than factory demand. Michael Oliver notes silver tends to move with gold, not broad commodity baskets like oil or copper. That matters because many investors still price silver through industrial narratives, while ignoring its monetary reflex during confidence shocks. If that framing is wrong, retirees and defensive allocators may underestimate how tightly gold and silver can re-rate together. Next, Michael Oliver reveals why silver's identity crisis may hide its biggest upside signal.
Okay. And then went sideways for a couple of years. But it doubled in price during that same late 2015 to mid 2020. The Bloomberg went down the whole time. Commodities went down. Gold was going up. Silver went up with gold. Okay. So I expect them to trend together, but I do expect gold to create something dramatic, but it won't be percent-wise anything like what I expect out of silver in terms of relative performance. So yeah, watch gold. It's a good place to be, but silver during this move to a new reality is a better place to be by far. And so are silver miners versus the gold miners. And when you plot charts, spread charts, relative performance between silver and gold, you could see that back last November, we took out a 10-year range high at very low relative levels, silver to gold, like 1.5% area, or closer to 1%. Okay. Heck, in 1980, it was 6.5% the price of gold. In 2011, it was 3.1. And right now, we're still under 2%. So if silver even just regained some of those old highs on the relative performance, it's already taken out those price highs. So why doesn't maybe the relative performance is going to catch up as well? Then silver will double, triple, or whatever versus gold. And the same with the silver miners versus gold miners. If you plot them as a spread chart, you can see they broke out several months ago. And sure enough, since then, silver miners have actually month to month been beating the gold miners.
A decade-long relative breakout at low ratios can matter more than headline spot prices. According to Michael Oliver, silver to gold relationships already cleared major long-term levels while still sitting far below prior cycle extremes. That creates a timing contradiction. Price may look elevated, yet relative performance suggests the move may still be early. Investors waiting for cheap-looking charts may ignore where institutional capital quietly rotates first. Next, Michael Oliver exposes why relative strength often warns before broad retail participation begins.
Nobody notices that, but it's a measurable event. And I think that's where you want to be in the monetary metals. Where could gold go? I don't know. All I can say is twice before, since legalizing, it had two eightfold moves. Different time spans, but both were eightfold dimension gains from bear low to bull high. I've said this before to you on your show. And if we have another eightfold move, it will be $8,500 because our last low was $1,050. Now, even J.P. Morgan came out with a report several months ago, fundamentally based, no doubt, that argued for $9,200 gold as a working target. I don't think it's a target. I think it's merely, I did it again. I've had another eightfold move. Well, that's nothing extraordinary. It's done it twice before, eightfold gain. This time we have fundamentals that are far more dynamic and nuclear than any ones we've ever had before. We have a government bond crisis, like Jamie Dimon told us 2 weeks ago. You got a government bond crisis now, and we're going to have to deal with it. And he didn't mean 10 years from now. He meant it's coming. It's now. We can't keep pushing it off. So that's an event that the public and financial TV really hasn't put up front as a major issue. I don't know why. That's fine. They'll figure it out later.
Do you think we'll eventually see the miners break out more versus the silver price, particularly if we enter this new reality for silver, the 300 to 500 range? What would that do for the silver miners?
Probably more than silver. Yes, I agree with that.
Bond instability rarely dominates headlines until liquidity stress starts leaking into everything else. What Michael Oliver is highlighting is that past gold cycles produced repeated multifold advances during far less fragile macro backdrops. The deeper contradiction is institutions openly discuss debt pressure, while retail narratives still fixate on short-term CPI and rate chatter. Wealth preservation investors should ask whether sovereign risk is being repriced quietly before financial television catches up. Next, Michael Oliver reveals why bond stress may matter more than gold forecasts themselves.
And if you measure them historically, like even the gold and silver miners via the XAU index, which has both silver and gold miners, it goes back decades to 1980s. And if you look at it, it's like 8% XAU divided into an ounce of gold. Heck, it used to live in a range for decades that oscillated with a median about 25%. It's 8%. There's a base we're trying to break out of. In fact, XAU marginally nipped out of it a couple of months ago in the recent surge, and it pulled back a little bit. The relative performance readings I'm talking about. Divide XAU into an ounce of gold. Okay. 11-year wide range with a fairly clear ceiling. You punched up through it marginally. But when we do GDX versus gold, it didn't quite break out. It's pressing at it. It's like third time at the same level trying to get through. When we see both XAU and GDX break out on a spread basis above that 11-year wide range of relative performance at very cheap levels, at that point we think the miners will gush, not just in relative performance, but in net price in a way that will shock people. Now, what might motivate the miners more than the metals? When the public gets nervous about the stock market, and we think the stock market is in a topping process. We thought we would get a rally to new highs back when we were under pressure because of the quote war news. People selling that were stupid. You don't sell headline news. That doesn't top a market. Headlines come later, the real headlines, like federal government debt crisis, debt collapse, private credit, and so forth.
An asset sitting near 8% of gold, after historically living closer to 25%, should force investors to question what normal even means. Michael Oliver's argument suggests miners remain historically cheap, despite already testing major breakout ceilings. If equity stress rises while metals stay firm, miners could reflect both leverage and revaluation at once. For conservative portfolios, ignoring relative value because headlines focus on geopolitics instead of structure may leave asymmetric opportunities untouched. Next, Michael Oliver unravels why market tops often arrive when optimism feels safest.
Right now they're focused on, tariffs. Well, that worked for about 2-3 months if you shorted it, and you got killed. Okay, tariffs didn't go away. And now the Iran thing. It hasn't gone away really, and yet the market made a low and then shot up to a new high, which we expected. I suspect we're going to top out in this quarter in price, S&P. And when we start to roll over in a way that tends to upset the investor and analyst, in other words, get their attention, because right now they're all measuring new targets up there, and there's nothing but good news. That's the environment you want when you top. You want all to be happy news. Iran war somehow melts away, civil disorder there, and the revolution on the ground level, et cetera. Or Ukraine-Russia war goes away. There's a lot of evidence that's about to happen because Putin is in political trouble in terms of maintaining power.
Markets often peak when headlines sound cleaner than balance sheets actually are. This is where Michael Oliver's thesis shifts towards sentiment risk, not war headlines or tariff fatigue. When indexes push higher despite unresolved geopolitical noise, complacency can become a stronger warning than panic. For investors near retirement, mistaking optimism for safety can expose capital just as volatility returns hardest.